Brody, Matt,
Here.
Morgan Brady, I think left.
Sorry, also, I'm here, Brody. I was just making a coffee.
Did you make enough for the rest of us?
I made enough for my roommate.
Good man.
Thank you.
Max,
I'm here.
Ryan, Martin,
Here.
Dejor.
Here.
Professor Gallagher, also Ryan Burns is here. He just said he's having trouble logging in.
Okay, thank you. Caitlin,
Here.
Bobby,
I'm here.
you're in the library without a mask on? Bousset,
Here.
Megan Hill, Jacob,
Here.
James Johnson.
Here.
Hey, you took down your jersey, man.
Yeah, you said you couldn't see me.
No, I could see you just looked like you had a funny hat on. That's cool.
Did it for you.
Ah, thank you, man. Brooke,
Here.
Jack Kenny,
Here.
Elias,
Here.
Brooklyn,
Here.
William, Love,
Here.
Paige, Noah,
Here.
where's Noah?
I'm here.
Madison,
Here.
Brendan,
Here.
Joe Pepano,
Here.
Tyler,
Here.
Abishri, Cole,
Here.
Kristen,
Here.
Carrie,
Here.
David, Styria,
Here.
Nolan,
Here.
Sean.
Here.
Anybody that I didn't call?
I'm here. Sorry.
Ah, okay.
Sorry, I had to just put in like the meeting passcode thing.
Oh, yeah. How is everyone? How was your first day of your first week of school?
It was
Did it
good.
suck as much as you thought it might, or was it okay?
It was okay.
Wasn't too bad.
Wasn't too
Just-
bad? Does anybody have any questions? Can you guys hear me okay?
Yeah.
Can you hear me better than the other day? About the
Like-
same. Same, huh? All right. So the other day we quit just before we finished the last problem, right? When the dollar is worth more in relation to currencies of other countries, are you more likely to buy American or foreign-made jeans? The dollar's really strong. Are you more likely to buy American or foreign-made jeans?
Wouldn't you be able to, you'd want to buy foreign goods because your money has more power and more value over the,
Yeah, you could take your dollars and you could go to Europe and you could buy more euros than if the dollar was weak. More euros means you could buy more pairs of foreign jeans because the dollar's strong, right? Does that help or hurt American producers?
hurt.
How come?
Because their money has more value in somewhere foreign than here.
Yeah, so you would rather not buy American goods, but buy Toyotas and BMWs and French perfume and German beer, right? What about importers in America? They're styling, aren't they? Because you're going to want to buy all those things and the importer is going to make money. Okay? We start chapter 2. We'll start it and we'll see what happens. Can you see my screen okay?
Yeah.
So we're going to talk about the financial system in chapter 2. An overview of the study of financial markets and institutions, direct and indirect finance, structure and components of the markets, different types of market instruments, talk about the international dimension, transaction cost, risk sharing, information cost, relative to financial intermediaries, different types of financial intermediaries, regulation, market regulation. So we touched on this in chapter 1, that the essential function of financial markets is to move money from people who have extra money to people who could use that extra money for investment. So maybe you're saving for something, you would have extra money. Maybe your roommate is trying to launch a music download business and he needs the money. The financial markets provide a mechanism for getting the money from you who have extra to your roommate who needs it. right? You can do that a couple of different ways, direct finance or indirect finance. So direct finance, borrowers will borrow directly from the lenders in the financial markets. In other words, you go directly to the source to buy securities. This promotes economic efficiency by producing an efficient allocation of capital. So it's very productive when you have extra money and your roommate needs money. That improves the well-being of everybody because you loan the money and you make money on loaning it, right? And your roommate uses the money to create a business that everybody's happy about. So we have this chart, and I'm not fond of charts like this, but anyway, we have lenders or savers, right? Businesses, government, foreigners, mostly households, mostly you and I. We have the financial markets, like the stock market or the bond market, and we have borrowers, firms, government, households, and foreigners. Notice households are in both. Households could be borrowers or lenders. They can go direct right through the financial markets, or they can go indirect by using an investment house or an insurance company, something like that, right? So the structure of financial markets. We have debt and equity. Debt is typically bonds, and equities are typically ownership in the market. I'll come back and talk to you for a minute. So debt is the bond market. When a company needs money and they issue debt, they're selling bonds. So if you buy corporate bonds, you're loaning that money to the company. The company in turn will make interest payments to you, usually every 6 months. And then after a period of time, at the maturity, they'll give you the money back. So bonds or the debt market, same thing, is loaning money to companies. Equities is actually buying a piece of the company. You're buying a share. The company issues shares, right? So back to the example of you and your roommate. Your roommate is trying to launch a music download business. He needs to raise money. He'll go to everybody on your floor and sell them a share for like $1,000, right? So, and then he uses that money to launch his business. By way of repayment, he'll give you dividends usually. Yeah, so you'll get a dividend probably quarterly if he's successful. If he's very successful and you've given him money, you could also earn money by saying after a couple of years, hey, I'm going to sell my share in your company at the market price. If it's very successful, you will have made money, capital appreciation. I got to show you guys one day, that was my mailman. All the windows are open, you know. But my mailman, he would just walk by. And he's like really, really slow. He walks really, really slow. But everybody calls him Speed. So it's like, hey, Speed. And he just grumbles, you know, because he's really slow. And next time, if he's put mail in the box and I hear him, I'll put the video out the window so you can figure out what I'm talking about. It's pretty funny. Hey, Speed, how you doing? Okay, so everybody cool on the equities and debt? Primary and secondary markets. Investment banks underwrite securities in the primary market. Brokers and dealers work in the secondary market. I didn't share that, did I?
No.
Investment banks underwrite securities in primary markets, and brokers and dealers work in secondary markets. So the primary market is the market where a company will bring shares to the market. So if we were talking about your roommate again, and he's got a very profitable music download business, and he wants to go public. In other words, he wants to sell shares of his company to the general public. He would do that in the primary market through an investment bank. An investment bank like a Bank of America or a UBS or something like that. He would call up UBS and say, hey, I've got a very profitable music download company and I want to take it public through an IPO. So the investment bank would then structure a deal and they would take however many shares of that company and sell them to the general public in the primary market. That's the only time we use a primary market. Thereafter, those shares would trade in the secondary market. The secondary market, like on the New York Stock Exchange, or in the over-the-counter market, or on NASDAQ, right? If it's a foreign company on the DAC, on the whatever. So the primary market is the first issue of shares of a company. The dude raises money from that. If the price of those shares skyrocket after he's launched them on the IPO, he doesn't make any more money, right? He just got the initial public offering money, right? When Facebook went public, if you had initial shares of Facebook, you got them. And Facebook doesn't get any more money because the price of that stuff goes up. Okay? The secondary market is where the shares of stocks that have been issued trade. So the New York Stock Exchange, the NASDAQ, the over-the-counter market, those shares trade between you and I, right? If we want to buy shares in an existing company, existing shares like Apple or Microsoft or something like that, we call a broker and he does those through the secondary market on the New York Stock Exchange or NASDAQ or whatever. That's between you and I. It's got nothing to do with Microsoft or Apple or any of those companies, right? Exchanges and over-the-counter. Exchanges means like the New York Stock Exchange, the Chicago Board of Trade, the NASDAQ. Over-the-counter means foreign stuff is traded like foreign exchange or Fed funds. Anybody want to tell me what the big difference is between exchange traded and over-the-counter traded? It's so freaking hot right now. And we have air conditioning, but I didn't put it on because it wasn't so hot a little while ago. if I want to buy shares in Apple and Carrie wants to sell shares in Apple, we do that trade on the exchange. Apple's traded on the exchange. So the exchange backs both sides of us. So if I were to do that trade with Carrie and I blew up, for example, and I owed her money, the exchange would make her whole, right? In other words, the exchange takes the other side of every trade done in the exchange traded market, whether it's the stock exchange, the futures exchange, whatever have you, right? The NASDAQ, whatever, right? The over-the-counter market is a trade done directly between me and Carrie. So if I wanted to do some odd sort of thing, and I called up a bunch of brokers and say, hey, I'm interested in doing an interest rate swap, for example. And here's my terms. And me and Carrie decide to do the trade over the counter. And then I blow up. She's left holding the bag. Nobody going to make it good to her, you know? So there's a risk associated with that over the counter versus exchange traded. Money markets are short term. Capital markets are long term. So the money market is like an overnight or 3 months, treasury bills, that sort of thing. You're investing money for a short period of time. Typically very liquid. You can get in and out of it easily. The capital markets typically deal in longer term, usually debt or stock, right? Money market might be T-bills or repos or commercial paper. Capital markets would be treasury bonds, corporate bonds, and common stock or preferred stock in companies. So the financial market instruments. These are money market instruments, right? U.S. Treasury bills, negotiable certificates of deposit. These are large denomination CDs, we call them, usually $100,000. Commercial paper. Commercial paper is if a company has, they want to do, they have $1 million earmarked to launch a project in 2 weeks' time, but they want to do something with the $1 million between now and then, so they loan it out for a 2-week period, short term, commercial paper. Fed funds and security repos. Fed funds are loans between banks, right? You remember from economics, the reserve requirements, and banks may borrow from one another to meet their reserve requirements. They do that through Fed funds. Security repos, again, a company may have extra money, and they'll go to a government bond dealer and loan them the money with the understanding they're going to buy it back, take the money back in the next day. So they're just locking it up overnight. They're going to repurchase it. Capital markets. Remember, capital is long-term. Money markets are short-term. Capital markets are long-term. Corporate stocks. Mortgages, corporate bonds, government securities, agency securities. if we were in the classroom right now, I would write down agency securities. I would write on the board Freddie Mac, Fannie Mae. That's the Federal Home Loan Mortgage Association. Those are backed by the federal government. So government securities. State and local government bonds. That's like the city of Olean issues a bond to build a new playground or a new park or buy a new fire truck. Commercial loans, consumer loans, commercial and farm mortgages, right? So bank commercial loans, Dunn Tire takes out a loan to build a new building or something like that. Consumer loans, you take out a loan to buy a new car, right? The internationalization of financial markets. So we have foreign bonds. These are bonds sold in a foreign country and denominated in that country. Eurobond, a bond denominated in a currency other than that of the country in which it is sold. So it's very important to realize we're not talking about in Europe here. It doesn't have to be in Europe. It's just a bond which is denominated in a currency other than the country in which it is sold. It could be South America, it could be whatever, right? Euro currencies, foreign currencies deposited in banks outside the home country. Again, it does not have to be a currency, the euro. Yeah, it could be anywhere. We just call it euros. Euro dollars. US dollars deposited in foreign banks outside the United States. So this is dollars, but they're outside the US. The world stock market helped finance corporations in the US and the US federal government. So function of financial intermediaries. This is indirect finance. Let's go back to, I'm backing up. We have been talking about the markets. Now we're going to start talking about intermediaries. Lower transaction costs, time and money spent carrying out transactions, economies of scale, liquidity services, reduce the exposure of investors to risk, so we have risk sharing and diversification. Asymmetric information, adverse selection and moral hazard, and small savers and borrowers to benefit from the existence of financial markets. So look, I want to come back to this. These people going through an intermediary can achieve economies of scale and liquidity. So you and I, as an individual, if we wanted to purchase a security, it would be very expensive for us because we'd be buying a small quantity. But if we went to a financial intermediary, like an investment broker, and said, hey, I want to buy shares in, what's Warren Buffett's company?
Berkshire Hathaway.
Yeah, I want to buy Berkshire Hathaway. Well, the investment company is going to say, you know, I've got 35 people this month that asked me about getting into Berkshire Hathaway. Because 35 people are going to do it, the investment company will get a better deal. That's what we mean by scalability and transaction cost, right? If you called them up and say, hey, I want in, they'd be like, okay, here, pay this commission fee. But if you called your investment house, your broker, they would say, oh yeah, we're going to do that. And you could get in at a better deal. Do you see what I'm saying? So that's what these things are, that's what this is talking about. Liquidity service, the same thing, right? There's somebody else in the investment house that probably wants to get out of the trade you're looking to get into. And risk sharing and diversification you can call your investment house and say, just give me a mutual fund with an exposure to the energy sector. And you'll have a spectrum of energy companies you're invested in. So you're diversified by doing that, as opposed to sitting at your desk in your room and saying, I want to get into the energy sector. I'm going to buy this company, that company, and this company. You're much more at risk than if you just used an investment company and bought a energy company mutual fund. Yeah. So the risk sharing feature of financial intermediaries is very attractive. Adverse selection and moral hazard. Try to avoid selecting the risky borrower by gathering information about them. And moral hazard, ensure borrower will not engage activities that prevent him or her to repay the loan. I want somebody to give me an example of each of these, because I'm tired of talking. And we've only got 9 more slides. What are we talking about when we say adverse selection? So when a bank makes a loan, they're going to find out about you, aren't they? They're going to try and find out everything they can about you. They're going to want to see your pay stubs. They're going to want to see your contract for your employer. Yeah. They're going to want to see your bank statements for the last 6 months. They want to know how much money you have. They want to know what you're spending your money on. And they want to know that they're going to get their money back. Right? So adverse selection would be giving money to somebody that's not likely to pay it back. Right? What's moral hazard? My favorite example of moral hazard, right? You learned about this in economics, right? My favorite example of moral hazard is you sign the lease to rent an apartment, and after you rent the apartment, you start barbecuing in the living room. That's not terribly clever. No, it's not a good idea. So, after the fact, you behave irresponsibly. That's an example of moral hazard. And yes, Jake, barbecuing in the living room is not a good idea. Trust me. So what they'll do is make you sign a contract. When you sign a contract to rent slaughter for the semester or for the school year, they're going to say right in the contract, no barbecuing in the living room. So financial intermediaries allow small savers and borrowers like you and me to benefit from financial markets. So financial intermediaries, the primary assets and liabilities. So we have commercial banks, they take in money. That's a liability for them. They have to give you the money back, right? Their assets are loans. They make a loan to you, and that's an asset for them. they're making money for that. Savings and loans, right? You remember the movie It's a Wonderful Life and the Bailey Savings and Loan? They take in deposits from people. That's a liability. And they make mortgages, right? Remember, what's his name? Jimmy, whatever the hell his name is, Jimmy Stewart, saying, no, I don't have your money, man. Your money's in Frank's house, and your money's in, Margaret's house, and all that other stuff, right? And I'm sure you've all seen the movie, so. Mutual savings banks, the same thing. They take deposits, they make mortgages. Credit unions, you all been down the main street in your hometown, and you see the sign that says, the so-and-so credit union. They take money and they also make consumer loans like car loans, typically car loans, or home improvement loans. Life insurance companies, they collect premiums. Then they use that money to issue bonds or mortgages. Yeah, you could get a mortgage from a life insurance company. Fire and casualty insurance companies, they collect premiums. Then they invest the money, corporate bonds and stocks, government securities, and they hope they don't have to pay out on their policies. Pension funds, government retirement funds, they take the employer and employee contributions and they invest it, right? Finance companies, they invest in commercial paper, stocks, and bonds. Their assets are consumer and business loans, so they give the money to consumers or businesses. Mutual funds, their primary source of funds is to sell shares, which they invest in stocks and bonds. Money market funds, the same thing. Hedge funds. So hedge funds are a little different. They're partnership participation. Usually there's a higher buy-in, maybe $250,000. And the primary investments that they do could be stocks, bonds, many other things. And they also have a lot less regulation. They're much less transparent because they're less regulated, because the government figures that the buy-in is so high that if you have $250,000 to get in, you must know what you're doing. Financial intermediaries and the value of their assets. So look at how these things have grown since 1990. That's 30 years ago. Credit unions. There's one of these. Finance companies, mutual fund, mutual market funds. Look at how they have all grown. Oh, regulation. But there's one of these I wanted to check out. Let's just go back for a minute. Oh, corporate stocks market value. Look at the change in market value of the corporate stock market from 1990 to 2016. This is a pretty significant, there's a lot of money there. And lots of professionals would be saying right now, look at the earnings per share is just like out of control. Are we in a bubble? Investment professionals would say, doesn't make sense that some of these things are priced as high as they are priced. Okay. So we did that, we did that, we did that. Regulation, increase the information available to investors. That's the big primary thing that the regulation wants to do, is get us to see what we're getting into. That would reduce adverse selection and moral hazard and reduce insider trading. They want to ensure that we don't have hiccups in the financial market, right? So they don't let just anybody set up a financial intermediary. There's a chartering process that you have to go through to be vetted. You have to disclose what you're doing, what kind of activities you're doing. You have restrictions on what you can do, right? They'll say, you can only invest in certain kinds of assets, and you have to have deposit insurance. They all have that now. Limits on competition. This doesn't really happen anymore. But it used to be that if one bank opened up on a corner in a small town, they would prevent any other bank from opening up. Why do you think that is? Why did they used to do that? Anybody? All right, since it's Friday. Because if there was another bank on the other side of the street, you would try to make more money than that other bank so that you held on to your depositors. So you would take more risk, thereby possibly causing a problem in the financial markets by taking on excessive risk. Honest, that's the truth. Doesn't happen anymore. It's mostly in the past. So here we have the principal regulatory agencies. The SEC. Who's not muted? Everybody muted? Okay, let's finish this up. It's too hot in here. The SEC, the CFTC, the SEC, Organized Exchanges and Financial Markets, that's NASDAQ, the NASD, the New York Stock Exchange. The CFTC moderates the futures exchange. Controller of the currency, these are commercial banks and thrifts. Credit Union Administration, these are credit unions, and this is what they do, right? We also have the state banking and insurance commissions. That's state chartered depository institutions and insurance companies. So again, you have to become chartered to do this kind of business, right? The FDIC, this insures commercial banks, mutual savings banks, savings and loans, and the Federal Reserve. They're the kingpin. They monitor all depository institutions. All right. That's all of chapter 2. Probably that's all we should do today because it's been a long week, right? And everybody's tired, right? Is there any chance of having fun down there at Bonaventure?
No fun at all.
No, Desjardins, no.
Nope, no fun.
So that means you can study extra hard this semester and do really well, right?
Exactly.
Yeah. Gotta look on the bright side, I guess, huh? Say, I'm going to tell the dean that all my students are really studying hard because there's not anything else to do. All right,
Yeah,
guys.
Whatever.
Now have a good weekend. Yeah, we'll talk to you Monday.
Thank you.
Thanks, Professor.
Thank
Have
you.
a good
Bye.
one.
Thank you.
Thank you.
Hello?
You talking to me?
Oh yeah. I don't think you didn't call my name during roll, and I just don't think I was updated onto the sheets yet.
Let me look. Michael, I
Yep.
thought you were going to try and get into the Tuesday, Thursday section.
Uh, I couldn't, so they put me into here.
Who?
Jenny Brockle.
Oh, yeah. Why couldn't you get in Tuesday, Thursday?
Because it's at the same time as 312 with you.
Oh. Okay. Let me look. Yeah, okay, man. You're in the class. You're registered. I didn't call your name because I'm using a sheet I printed out a couple of days ago.
Oh, okay, okay.
Sorry, man. I didn't see it.
No, no worries. Thank you.
All right, dude.
All right, I'll see you Monday.
Okay, bye-bye.